The matrix is a system. That system is our enemy. But when you're inside, you look around, what do you see? Businessmen, teachers, lawyers, carpenters. The very minds of the people we are trying to save. But until we do, these people are still a part of that system, and that makes them our enemy. You have to understand, most of these people are not ready to be unplugged. And many of them are so inured, so hopelessly dependent on the system, that they will fight to protect it. Now, that line was from The Matrix, as most of you probably know. And the reason I opened this video with that line is because I'm going to address some of the comments posted in our last video, which was called Epic Banker Lies, the Truth About Gold, Silver, and Stock Markets. Now, I'm going to address some solid comments that were in there, but just provide my rebuttal as to why the facts that we raised in that video are still valid and maintain a lot of weight. And then secondly, I'm going to address another class of comments we always receive, which are those comments that always resist any truth or facts we present and pretty much side with the side of the system, which enslaves them. So the line, that opening line from The Matrix, pretty much also reflects the German philosopher Goethe's comments, which he said, none are more hopelessly enslaved than those who falsely believe they are free. Okay, so let's start with one comment as far as the dividend yields being missing from the S&P 500 in our 13-year comparison from 2001 to 2013 of the performance of physical gold, physical silver, and the U.S. stock markets. Now, we actually did calculate the returns adjusted for real inflation with the dividend yields of the S&P 500 every year. So if we consider someone just invested in an index fund where your expense ratio is extremely low, say 0.20%, and we look at the actual dividend yields of the S&P 500 every year from 2001 to 2013, which ranged from 1.37% to 3.24%, with an average of less than 2% a year. If you account for the true inflation rates, now even if those dividends were reinvested every year, the compounding effect of that dividend yield does not make that great a difference when you use true inflation rates. Now, if you use the falsely produced banker government inflation rates, where you're saying inflation is only 1 or 2% or a year, then you might have a greater compounding effect. The reality is, even if we include all the dividend yields from 2001 to 2013, when we're adjusting for true inflation rates, the real returns of the S&P 500 are still negative 56.57%. So that's just slightly better than the negative 65% overall return of the S&P 500 from 2001 to 2013, not including dividend yields. Now, the reason we didn't include dividend yields is because our whole point is we were comparing if someone were to take action for themselves and had invested in physical silver or physical gold since 2001, what the returns would have been from the start of 2001 to 2013, whereas if someone had invested at the start of 2001 in the S&P 500, what the yields would have been. Now, we are considering the fact that if you have a portfolio that's actively managed, almost no one on Wall Street or no commercial global investment firm is going to put you in an index fund because they don't make any money off of the fees. So they want you in an actively managed fund. So if you're in an actively managed fund, first of all, the management fees are going to be anywhere from 1.5% to 2% a year. Now, that's not even considering that in each of those funds, so say you're in a small cap fund, a mid-sized cap fund, a large cap fund, international fund, or whatever, that you're going to have cash drag because all of these actively managed portfolios need to have a certain portion of their portfolios in cash throughout the entire year to service any redemptions that are ongoing through the course of the year. So studies have shown that cash drag, the expense of that is another on your performance is about 0.83%. Then there's transaction costs, the various commissions that the firms are going to charge you out of those funds for trading in and out. So on average, again, studies have shown that's 1.44%. So you add up all these fees, you're already up to a minimum of 3.77%. So you're up to 3 or 4%, which is well over the average dividend yield of the S&P 500 of less than 2% every one of those years. So we are actually even being generous in just looking at the returns of the S&P 500 from 2001 to 2013 without actually subtracting the expense ratios or the underperformance of these actively managed portfolios to the S&P 500 index that most people would really have to account for during those years. Now, let's look at peak oil. The whole point of me bringing up peak oil in that video was not to discount the fact that that could be a possibility. You know, obviously I'm not a geologist. I haven't studied that particular subject intensely to really decide whether, there's two arguments, that oil is a renewable source of energy, or that there is going to be decreasing supplies of oil, and that is going to cause a rise in the price of oil. So, but the first point is just that no commodity is really set by true physical supply and demand, because the biggest influence over setting the price of commodities is in the futures index, which just trades paper contracts. But the other point is, the point I was making in that video was just for the fact that bankers were using peak oil, and they said peak oil would occur in 1970, I believe was the first year. Then again, they revised it to a year much further out. The only point I was making that is, if you look at the facts, what the bankers were trying to sell did not coincide with what was actually happening. Because reality is, unless you have a high-ranking position within OPEC, you're really not going to know what the real numbers are, because those guys are the only ones that know what the real numbers are. Okay, and then for those that say, oh, you are presenting these facts, but you're cherry-picking this period to try to make the performance of gold and silver look much better than it really is. Well, there's a couple of things wrong with that argument right off the bat. Because number one is, the whole point of that video was the fact that there is something very different about this period from 2001 and 2013, which is the most relevant period, because it's a period we're living in. So if you look at this chart, I'm going to start right here, of the performance of Japanese government bonds, what do you see? The yield has collapsed since when? Since when? Starting in 2001 until now. So why is that important? What does that have to do with U.S. stock markets, you might say? If you don't understand that, what the Japanese yen carry trade has to do with the performance of U.S. stock markets, then you don't really understand the performance of U.S. stock markets. So that's something, that suggests that you go research, and you will understand why the currency devaluations that every central bank in the world is engaging in today has made this period different. And there is a difference in this period, and that is why I discussed that period. 13 years is not 13 days. That's a very long time, and a very appropriate period of time given the difference as is clearly visible on the Japanese government bond yield chart. And thirdly, I just want to mention in that last video, when I mentioned gold and silver, I was specifically speaking about physical gold and physical silver, as those of you that have followed me now for years know I always advocate physical gold and physical silver. And in fact, we're one of the first people to come out and speak out against paper gold, paper silver, like the GLD SLV, as a risky investment that probably is filled with re-hypothecated gold and silver, and is not something that you should ever consider as a proxy for physical gold and physical silver. And as well, we're just looking at gold bullion and gold silver prices. If you factor in coins, which we always have recommended to our paying clients, then your profits are going to be even greater. In fact, when we first launched our company, I specifically recommended a gold coin that has now since increased in value, because I just saw on eBay this week that it is selling at 3.58 times the purchase price. And in fact, we recommended it at $610, and now it's selling on eBay well over $2,100 per coin. Okay, so whereas the price of gold more than doubled, went up about 124% since the time we recommended to our paying clients to buy this particular coin. That coin has increased by over 258%, so more than double the profits of gold bullion bars. Before I move on to, I also want to note that a lot of people say, oh, you're just selling your book when you tell people to buy gold and buy silver, which is absolutely false as well, because I have never dealt in selling physical gold, physical silver, so I've never made a dime off of my clients that have bought into physical gold and physical silver. I could just as well tell them to buy into the US stock market, the FTSE in London, if I believe that those were the best vehicles and assets for them to own. So I have no personal stake in any of my clients buying physical gold or physical silver over any of the stock market indices, other than guiding them to what I believe is the best possible asset to preserve their wealth. And lastly, I just want to conclude by saying that in the early 1900s, people really understand the system, which in this case, you can even substitute the banking system for the system that's spoken about in the Matrix, because it is totally relevant, totally apropos to how it applies to that statement. So those that are most enslaved by this banking system are unfortunately the ones that most support it at times by refusing to internalize the facts, by refusing to see the facts that are presented, and by supporting the system of enslavement. So in the early 1900s, back to my original point, there were plenty of arguments, articles written by very prominent people in the United States arguing that the fiat currency system was an immoral system. Not just a system of deception and fraud, but an immoral system. And back then, the majority of people understood why it was being argued as an immoral system, and the majority of people agreed that it was an immoral system. So think about that. What has changed in the last century that nobody understands? And could it possibly be because that part of history, the real truth, the real facts about the global banking system has been erased from history by the banking industry? So that's what I want to really impress upon people, that please open up your minds and support the system that is enslaving you. Okay, thanks a lot for watching. And as a last reminder, our flash sale on all Smart Knowledge U services, which amounts to a 30% discount off of our late 2012 prices, is going to end today, June 25th. So please visit us at www.smartknowledgeu.com to take advantage of this 48-hour flash sale. Okay, thanks again for watching, and remember to always stay intensely curious.